Wondered what debt funds are and how they work? Let's unravel this financial instrument together. Debt funds, also known as bond funds or fixed income funds, are a type of mutual fund. They primarily invest in fixed income securities like government bonds, corporate bonds, treasury bills, and other money market instruments. The crux of these funds is to provide regular income to investors. Imagine a pool of money collected from many investors. This pool is then allocated to various fixed income investments. These investments generate interest over time, providing a steady stream of income. The main goal here isn't necessarily high returns, but rather predictable, steady income. This makes debt funds a popular choice for conservative investors looking for stability and less risk. So, in a nutshell, debt funds are investment avenues for regular income. They offer a safer route in the tumultuous world of investments, providing a steady hand in the often unpredictable financial market. Now that we know what debt funds are, let's examine how they differ from equity funds. Investing can often feel like navigating through a maze with a plethora of options and terminologies. Two such options that often create confusion are debt funds and equity funds. These are two distinct types of mutual funds, each with its own set of characteristics, risks, and potential returns. The primary difference between debt and equity funds lies in the type of investments they make. Debt funds, also known as bond or fixed income funds, primarily invest in fixed income securities such as corporate bonds, government bonds, treasury bills, and other debt instruments. These funds aim to generate income through interest payments and are generally considered less risky than equity funds. On the other hand, equity funds invest predominantly in stocks or equities of companies. The performance of these funds is directly linked to the stock market, and they aim to generate high returns over the long term. However, with this potential for higher returns comes higher risk. The value of an equity fund can fluctuate greatly due to market volatility, which is not the case with debt funds. To put it simply, if you're a thrill seeker in the financial world, equity funds might be your ride. They can take you to great heights, but there might be some steep drops along the way if you prefer a slow and steady ride. Debt funds might be more your speed. They offer a less bumpy journey, but the scenery might not be as breathtaking. It's also important to note that both debt and equity funds have their place in a well-diversified investment portfolio. You might choose to balance the stability of debt funds with the potential high returns of equity funds, depending on your risk tolerance, financial goals, and investment horizon. So, while debt funds offer steady income and lower risk, equity funds offer potentially higher returns with higher risk. The choice, as always, is yours, but remember, knowledge is power. The more you understand your options, the better your investment decisions will be. Now let's unravel how debt funds actually work. Debt funds, in a nutshell, are mutual funds that invest in fixed income securities. These securities are essentially IOUs issued by entities such as governments, municipalities, and corporations. The issuer of these securities borrows capital from the debt fund and agrees to pay a fixed interest over a predetermined period and return the principal amount at maturity. The primary sources of returns for debt funds are interest income and capital appreciation or depreciation. Let's take a closer look at these. Firstly, interest income. When a debt fund invests in a security, the issuer promises to pay a fixed interest, also known as the coupon rate, at regular intervals. This periodic interest forms a significant part of the returns generated by debt funds. But there's another side to the coin: capital appreciation and depreciation. Here's how it works. Bond prices and interest rates share an inverse relationship. When interest rates in the economy fall, bond prices rise, leading to capital appreciation for the debt fund. Conversely, when interest rates rise, bond prices fall, causing a capital depreciation. This is why debt funds are considered less volatile than equity funds. While equity funds are subject to the ups and downs of the stock market, debt funds have a more predictable income stream from the fixed interest payments, although they are not entirely risk-free. In the grand scheme of things, debt funds aim to provide steady returns with lower risk. They are a preferred choice for conservative investors seeking a safer avenue for their investments, away from the roller coaster ride of the equity markets. So, debt funds work by investing in fixed income securities that promise a regular interest income and by capitalizing on the changes in interest rates. These funds strike a balance between risk and reward, offering a safer yet rewarding investment option. So debt funds work by generating returns from interest income and capital appreciation. It's time to understand where debt funds invest their pooled money. Debt funds, as their name suggests, are all about debt. They primarily invest in fixed income generating securities, and these can take various forms. The primary investment avenues for debt funds are government securities, corporate bonds, and money market instruments. Let's delve into each of these avenues to understand how they assist in generating regular income. Firstly, government securities. These are essentially loans that the fund gives to the government. In return, the government provides a fixed interest rate. Since these are backed by the government, they are considered to be very safe investments. Next, we have corporate bonds. These are similar to government securities, but in this case, the loan is given to a corporation instead of the government. The corporation then pays back the loan with interest. While the risk is slightly higher than government securities, the potential returns are also greater. Lastly, we have money market instruments. These include treasury bills, commercial paper, and certificates of deposit, among others. Money market instruments are short-term debt instruments that are highly liquid and carry minimal risk. They help in generating steady returns over a short period. Each of these avenues contributes to the regular income that debt funds generate. The government securities provide a safe and steady stream of income. The corporate bonds offer potentially higher returns, albeit with a slightly higher risk. And the money market instruments offer liquidity and short-term gains. What's interesting about debt funds is that they don't just stick to one type of investment. They diversify across these avenues, balancing safety, returns, and liquidity. This diversification helps to mitigate risk while ensuring a steady income stream. So you see, debt funds are not just about lending money and earning interest. They are about strategic investments in various debt instruments to maximize returns while maintaining an acceptable level of risk. Therefore, debt funds invest in a variety of fixed income generating securities to ensure regular income. Finally, let's delve into the different types of debt funds. These funds come in a variety of flavors, each offering its unique blend of risk and reward, suited to different investment horizons and risk appetites. First up, we have liquid funds. These are the safest of the debt funds, investing in securities with a maturity of up to 91 days. This short maturity period significantly reduces the interest rate risk, making them a go-to choice for investors seeking a safe harbor for their funds. Next in line are ultra-short duration funds. These funds invest in securities that mature between 3 months to 6 months. They offer slightly higher returns than liquid funds, but come with a little more risk due to the longer maturity period. Then we have short duration funds, which invest in securities maturing between 1 and 3 years. They offer a balance between risk and return and are well suited for investors who can afford to take on a bit more risk for higher returns. Following this, we have medium duration funds. These funds invest in securities maturing between 3 and 4 years. They offer higher returns than short duration funds, but also come with higher risk due to the longer maturity period. Next, we move to long duration funds. These funds invest in securities with a maturity period of more than 7 years. They offer the highest returns among all debt funds, but also come with the highest risk. Lastly, we have dynamic bond funds. These funds have the flexibility to invest in securities of varying maturities based on the fund manager's view of interest rate movements. They offer a dynamic mix of risk and return, hence the name. So, depending on the investment horizon and risk appetite, one can choose from a variety of debt fund categories. Let's recap what we've learned today. Debt funds are investment pools where money is parked into various debt securities. Their unique feature is that they offer a fixed return, a stark contrast to equity funds which have fluctuating returns based on market conditions. We've also unraveled the inner workings of debt funds. They operate by investing in fixed income securities like corporate bonds, government securities, treasury bills, commercial paper, and other money market instruments. This is how they generate income. We then explored the different avenues where debt funds invest. They strategically place their assets in places like corporate bonds, treasury bills, and commercial papers, to name a few. Finally, we delved into the categories of debt funds. We have liquid funds, ultra-short-term funds, income funds, dynamic bond funds, gilt funds, and credit opportunity funds, each with its own unique features and benefits. Remember, understanding your own risk profile and investment goals is crucial to choosing the right type of fund for your portfolio.